Hi, Peter.
Hey, how are you, Dale?
Okay, Peter. So, sorry it's been so long. I know we had some trouble getting it together.
Yeah,
I think back in June when you were talking about a move to 3,400 to complete this. So, uh,
yeah,
great to
yeah.
have you back. And
Thank you. Thanks for having me, and I apologize for bailing out on you
oh,
on
that's
the last
okay. It
time.
happens occasionally with
So I'm
people.
gonna try and fit all this in
All right,
inside 30 minutes.
I'm gonna be out of character and not interrupt you a lot.
All
So,
right.
just go ahead, buddy.
All right. Let's look at what's happened over the last 3 weeks, up until 3 weeks, and I've written about that on February 10th and 14th to my subscribers, and I shared it with the public. But I've always wondered what's going to be the catalyst for this correction. And here's the thing about the coronavirus. It's occurring at a cycle peak, unlike the Asian flu of 1957, SARS of late 2002, and the swine flu of late 2009, which all occurred at a cycle bottom. So how much further could have stocks gone down? And so today we live in a different world. You got economies highly reliant on China-based supply chains. And I have a little business that produces products in China. I can order stuff right now, but I have no idea when I'm going to get it.
What's a butterfly effect?
Butterfly effect is the chaos theory, meaning
Okay.
the smallest flutter of a butterfly's wings will send ripples around the world.
Okay, got
So,
it.
and that's why, so easy. So is the coronavirus recessionary, deflationary, or both? Either way, it's going to have some sort of a recessionary effect on the economy, an economic downturn per se. So it's coinciding with the presidential election, which calls into question the consensus on the outcome of this election because, the president always boasts about a stock market being at an all-time high, having the lowest unemployment, et cetera.
Yeah.
So here are the three bear markets that I'm citing. In 1957, we had the Asian flu. The S&P, or the stock market, had been in a bear market since August 56, when this flu spilled over to the US in very light outbreaks in August 57. The market was 2 months away from bottoming. The bear
Oh,
market was.
I just stay home from nursery school.
Yeah,
You probably
and
weren't born then.
I wasn't born.
All right, go ahead.
And,
Rub it in.
and no, but not I was born in 66, so you can.
Okay, yeah, go ahead, rub it in.
So when the swine flu spilled over, the Asian flu spilled over the US, there was already a vaccine. So anybody using the SARS playbook, for example, let's look at SARS. It occurred when? 2002, late 2002. That was the bottom of the bear market on the heels of the dot-com bubble burst. Same thing in 2009. We're starting to recover from the financial crisis. So how could you use that playbook to justify staying the course? Because that's what financial advisors were telling friends of mine. Stay the course. It's a presidential election year, historically bullish. The flu won't have more than 5% effect on the stock market. So, but this guy, Alarian, was pretty smart. February 3rd, he said, don't buy the dip. Probably he saw the timing of this. When he said this virus is different, what he meant is that the timing of it is different, not necessarily the impact of it from a human perspective. Again, end of January, some of the big guys are saying that we can justify staying in equities because there's a lot more lining up to support equities. But again, these guys, extremely smart guys, their time frame is a lot different than mine and yours. They're talking in terms of years, we're talking in terms of weeks and months, us traders, right?
Yes.
So here's a typical CFA. Up until a few days before the top, he's analyzing earnings data. He's looking at the rate of change on forward estimates, and he's concluding that it makes sense to stay with the mega caps. That's February 16th. But it's a very smart guy, and I understand why, because the trajectory of earnings, except for that little rough patch in 2015, 2016, the trajectory has been up, which completely explains why you extrapolate the past to predict the future. So unemployment, today's report was really strong, but it's backwards looking, we all know that. However, one thing to look forward to is the April and May reports, because last 10 recessions, something happened, and that is the trough in unemployment preceded every recession by an average of 4 months, okay? So today, unemployment is still at an all-time lows of 3.5%, but the moment it jumps up by 50 basis points, it's a perfect recession indicator. It has been for the last 70 years. So right now, there's nothing to worry about so far until we get reports that are impacted by the effect of this virus. Let's talk about the yield curve. I'm not an expert there, but I know that this is a bull steepening yield curve, okay? And I've done my research. A bull steepening yield curve, all you have to go to is this Market Watch article that says that a steepening yield curve is not necessarily good for investors, because while the yield curve can point, a steepening one can point to better economic times, it's also, oftentimes it's a precursor to a coming recession. And so what is this rate cut all about? It's a panic rate cut, in my opinion. It's trying to backstop what's about to happen. In other words, let's cut rates, but also let's say that the economy is doing great. But I think they're trying to get in front of it. And what about the message of gold? Now, I saw the previous presentation where gold was I believe the Elliott wave showed 1, 2, 3, 4, and 5. But my characterization, my interpretation of this is a little different. And what I see, I'm going to use pink or blue or something. That was an ABC, XABC. Actually, I have it labeled. I don't know why I'm drawing on top of it. That was my interpretation. You have a real nice inverse head and shoulders continuation base. We broke out of it, and we're definitely headed back to the top right here. I'm expecting a cup and handle and gold to soar below, above 2,000 in the coming months.
Okay.
For now, the target is the all-time highs, 180, 190.
Okay. Got it.
And moving forward, let me talk about my forecast, past, present, and the warning signs I saw over the last few months. That was the June forecast. We rallied off the bottom, December 2018 bottom, rallied to new all-time highs, pulled back into early June. I labeled this wave B, and I put a minimum target of 33, 36. Okay. Now, it ended up being this. I moved the B wave up to October 3rd, actually, and it was a running to flat triangle. Why did this happen? You always have to correlate your analysis with events. You can't do it in a vacuum. So why did the rally begin? We were promised a trade deal. How many false starts did we have? How many setbacks did we have? I would say 2 or 3%. So while the market was wisely betting on a trade deal being signed because neither country can afford not to, the S&P traced out a wait-and-see pattern, which, by the way, you can see this triangle much more nicely on the futures. I'm going to show that in a second. But the same triangle exists on the Dow Jones, on the NASDAQ futures, S&P futures, and the semiconductor index. Okay, same exact pattern. So that's why I actually raised my target from a technical perspective to 3463, meaning I was looking for a C wave to be equal the A wave. But you know, I learned a lesson here, because eventually valuations are valuations. You should not really be fixated on the beauty and the symmetry of the chart. So it got pretty much to where I originally expected it to reach. And for full disclosure, I was long right here and stayed long. And when I saw what happened on February 20th, 21st, I immediately hedged that position with weekly credit call spreads. and exited everything on the 24th.
Okay. Nice. So you know, WD Gann, if you don't learn how to change your mind, you won't have any change left.
That's right. And I've been very hurt in the past many times by my inability to change my mind. And that's something that I've worked on.
Everyone has, Peter.
It's really hard to press that, you know, to rush to the exit. You got enamored with your own positions. It becomes really hard. So here's the triangle on the ES. It's a barrier triangle per Elliott, using Elliott speak here. And then on October 3rd, when we got that weak manufacturing report, it was the bottom right here. And actually, this is what happened. We went all the way down past the volume point of control of 2019, and we retraced everything down to the penny that has happened since October. In other words, we erased all the Q4 2019 gains by this first move. Here's the SOX. That was my forecast for the SOX. We have a massive cup and handle. And think about it from a technical perspective. Something happens, an unforeseen event, some crisis comes out of nowhere. What do you think happens on the heels of a breakout? You come back down and retest the rim of the cup. Sometimes you go all the way down to the bottom of the handle. So as of today, I don't think the SOX has even gotten close to support. In fact, it got down to here, 1600. And at some point, I expect it to go all the way down to here. And should that red dashed line be breached, we're going to retrace all, if not most, of the fourth wave. But again, the future is bright as far as I'm concerned. This SOX, once it finishes correcting, it's going to soar and go past 2,000, reach as high as 2,600.
Can you go back to that just one more time?
Sure.
Okay, so you think there is a possibility of a pullback to 1,400?
I would bet on it that there will be, and I'm going to show you why this correction isn't over yet and what's happening, what has happened, what's happening today. And yes, not only 1,400, but listen, if this gets worse from a supply chain perspective, who knows, sentiment, we could go past 1,400.
Negate the breakout.
Yeah, we could negate the breakout for a while if there's a recession. We just don't know yet. Numbers don't show it yet, at least not fully. NASDAQ Composite, I felt like a fool in February because since 2013 and then 2015, my ultimate target was 93.60. We got to it in June, we hit it, pulled back, January. And then February, all these passive flows, man, it was incredible. This red candle used to be a beautiful green candle approaching 10,000. Suddenly, look at this reversal. I felt like a fool up here. I said, I must be missing out or missing on something. I must be missing something as far as my technical analysis. So I'm going to raise my target to 10,000 because I'm starting to capitulate. But here we go. The string got stretched way too far, and now we're seeing the effect. So the triangle is right here. I think we pulled, this is a little old chart. I used that chart in my presentation before last week. So when you look at it, you'll notice that I think we got down to here, 8,200, 8,100. Yeah. I think at some point, because the nature of this bearish crab, I don't want to get too technical, but this massive crab pattern reached its target in 2018. There was an unwarranted fifth wave, and then we crashed in 2018. And then we went past it, tested it, and finished the fifth wave. Now, what happens when the fifth wave is over? You come back down to support. This is not support. Last week was interim support. We're going to get down here, 7,600 to 7,000. Okay, what is the crab potential reversal zone? It's being back tested, 7,000 to 7,600. I'm going to show you this on a different chart, why these two levels are true support. And that's going to come up in a few minutes. So, warning sign, the transports. In November 2014, late November 2014, the transports printed a high. However, the S&P and the NASDAQ, they kept on plugging along until early summer, late spring, early summer 2015. Now, transports were on a decline. And then when the string finally snapped, S&P at all-time high, NASDAQ at all-time high, they all came down together, partial bounce, and the decline, they all declined together into early 2016. Now look what happened here. Transports topped in September 2018. Everything came back down, or came down together into December 2018. V-shaped recovery, mid-2019 consolidation. Trade deal is signed, confirmed and everything. We rally. We don't make a new high. S&P, NASDAQ are at my targets, and now I'm patiently waiting for the transport to break out, and they wouldn't do it. So what happened? When did they top? Transport stopped in January, right when the first case of the coronavirus hit the US. Okay. Same thing with the NASDAQ Bank Index, which I'm going to show in a minute. So I looked at the chart. I said, you know what? This thing isn't going to break out. So I'm going to see if this was a failed breakout. If this is a failed fifth wave, we're going to reverse. So I looked at the Fibonacci ratios and determined that this is a picture-perfect harmonic shark pattern. Not only that, but there was also what you can also, I'm sure you can discern this head and shoulders here. And when did it break out? Or I'm sorry, when did it confirm?
Yeah.
February 24th.
Is it natural for an analytician like you to also be integrating harmonic patterns into it?
Yeah, my analysis framework is a hybrid framework. I never ever look at one particular thing in a vacuum. Every single analysis approach is mired with flaws, and there's no approach that is infallible. Let's put it this way.
Yeah, that's so true.
And here's the other thing. I'd like to tell this to all Elliott guys out there. Let's say that every stock follows a wave pattern. Let's make that assumption. Now you have some stocks that are in a bear market, others that are in a bull market. So how come an index of 500 capitalization weighted stocks magically follow an Elliott wave pattern? I could never really understand that, you know. But here's the thing. I use Elliott wave when it, when it shows a clear-cut pattern, but I also try to confirm it with other approaches, including some valuation information, S&P value, earnings valuation, so on and so forth, which I'm going to show in a minute. So yes, head and shoulders, it broke down February 24th, and look where we are right now. Now, relative to, where was it? I'm sorry.
Yeah, way overshot the formation target.
So here's the formation. Look where we are as of yesterday. That's as of yesterday. I think today.
Okay.
I think today we're going to hit this this area. The S&P is likely to retest the lows and bounce off the lows, and I'm going to tell you why. I don't think we're going to break those lows because a lot of things are going to hit downside targets, including the
You're talking about 2850.
Yeah, 2850. Yeah,
okay.
2850-ish. We're going to retest it because everybody is salivating over the prospect of buying back the low, expecting a breadth thrust. So we'll see if it happens. Here's the bank. That's what I use for financials, the NASDAQ Bank Index. It's a beautiful pattern. We had a crab pattern dating back to December 2016. Elliott wave reached the center of the potential reversal zone. I called the high right here. We got a fourth wave, or at least what I thought was a fourth wave. We'll find out if it's a fourth wave or is it 1, 2, 3, 4, 5. I don't know. We'll find out soon. That's when Elliott wave becomes very subjective. But here's how I interpret this chart. Okay, everything came down together into late December. We bounced back. Mid-year, mid-2000, what happened in 2019? Sideways consolidation. We finally broke out of this flag, and we reached the edge of the PRZ right when the first case of the coronavirus appeared. And look what happened since. We're back down to what? The December lows. Okay. Who knows? We might be going further down, because if this formation is an ABC and this particular structure is 1, 2, 3, 4, 5, who knows? I don't know. Maybe we're going to go down further. I have no idea at this point. I'm going to keep my mind open. Keep an open mind about this.
Okay.
Here's the head and shoulders on the bank index.
Yeah.
As of 2 days ago, we're down 20%. So this thing is in a prime time bear market. Russell 2000, same thing. That's another warning. Failed to break out to new highs.
Yeah.
This a failed fifth wave. The target remains again, what looks like a sharp pattern here. The downside target is the December lows.
Okay.
Here's another worrying sign. I've been tracking this for a couple of years. Equal weighted S&P versus the cap weighted S&P doesn't look really good starting in 2017. It seems to me that when everything, for the longest time, the equal weighted was outperforming the capitalization weighted benchmark index. But then suddenly what happened, probably the mega caps started taking center stage, and
the concentration
leadership narrowed. Yeah. Okay, up until a point where it couldn't take it anymore. Here's the Dow Jones. I like the Dow Jones because it's got a few components in it. So an Elliott wave on it, it's probably a lot nicer than an index with 500 stocks, even though the other indices also follow the same exact wave structure. And by the way, I don't use the classic Elliott wave. I use the harmonic Elliott wave, which Ian Copsey invented. And it basically advocates that waves 1, 3, and 5 move in 3 waves. And so far, so good, right? So again, we had a triangle in mid to late 2019. And last week's bottom occurred exactly what I thought. The bounce occurred or reached 50%, which is the top of the triangle, about 2,700. And now it seems we're coming back down here very fast. So I think we're going to bounce back up here. And what will happen is we're going to have a head and shoulders by late April, May. So the adage, sell in May and go away, might be more fitting than ever this year. Now, if this happens, and it's all prognostication at this point, right? If this turns out true, look what the measured move of this head and shoulders will be. By the way, I did revise this up to 27,600, 700, and I was wrong. I did that a couple of days ago. Head and shoulders, let's say that we do get a head and shoulders in the next few weeks, and then we break down, we break below the neckline. What would the measured move be? The lows of the fourth wave. Okay, so we're going to get down here if we break. So we'll see how it goes.
Okay, nice looks.
Here's what I saw on the day that we bottomed last week. We got down to the volume point of control for 2019. In fact, we got a little lower. We erased all the gains for Q4 2019. When that happened, at the same time, the NASDAQ hit its 200-day moving average. Okay, should that 200-day at some point be taken out to the downside, what do you think we're going to do? Here's the Elliott wave, Elliott wave rule. Triangles precede the last move in the prevailing trend. And that's why I knew that this is a top. So at some point, we're going to get down. Remember what I said a few slides ago? I said, look for the crab pattern, the PRZ for that crab pattern, which was 7,000 to 7,600. This is the volume point of control for 2019 and the value area low for 2019. So at some point, I'm expecting the entire triangle to be retraced. Okay.
Are you saying back to 2016 levels?
No, the low right here is the June low.
Okay.
Right here is the early June 2019 low. And from there on, we'll figure out what's going to happen next. So
I don't know. I was kind of thinking, you know, everyone named this rally from 2016, the Trump rally, that perhaps what we do is wipe out the whole Trump rally.
Very
I'm not sure
possible.
where would that take us to? About 2,400, right?
Oh my God! Listen, I have I'm a Republican, just for all for disclosure's sake. But I have two bets with friends that he won't get reelected, and I was basing all this on my analysis. So you know.
So if the market won't be recovering into the election, is that what you're thinking?
I'm thinking that he can't boast about the market being at an all-time high.
That's true.
How many presidents have gotten reelected in a recession? I don't know. You know,
none. Franklin Roosevelt.
Yeah. So. Valuation, I'm going to show you something about it. I'm not a fundamentals guy, but I've recently expanded my framework to include this. Look at PE, historical PE, going back to October 2009, when PE dropped to a semblance of normalcy, because up until Q4 2009, PE was 80 because there were no earnings. But then we started getting earnings, it dropped down to something more reasonable, 20 to 22. And then, you know, the market was on shaky, precarious grounds for a while, and then we accelerated. And every time the PE reached an area of 24 to 25, something comes out of nowhere to trigger a correction, okay? Yeah. 2015, 2016, we got up to the highest PE in that 10-year span in 2018, and we corrected big time into December, down to a
puke job.
Yeah, exactly. And then what happened in 2020? We got back inside that
because Yellen and Bernanke and Powell all held hands and sang "Kumbaya."
Exactly.
So it was completely a Fed-induced recovery.
Well, to a certain extent, but companies do have earnings, you know.
Oh yeah, I forgot about that.
We gotta admit that too. It's not like 2000. So we technically, I'm looking at this technically. You know, I'm looking at PE technically. Every time we get inside the danger zone, something comes out of nowhere, giving the market an excuse to sell off. Now here's my model: the daily prices of the S&P, as well as full year earnings, okay, trailing 4-quarter earnings. Historical PE average of 19.4, you take the earnings, you multiply it by this historical average, and you get a fair value of about what? 2,700. Again, it jives well with the previous targets I was talking about, 2,760 or so. Now, as of last week, the full earnings for 2019, because Q4 was strong, they went up from 138.91 to 139.72. Now look here in the middle, the chart in green, I have 19.78 PE instead of 19.4. Why? Because since Q4 2009, if you take all the PEs and you average them out, they average out to 19.78. Multiply 1978 by Q4, by full year 2019 earnings, you get 2763, which is in line with my interim low of 2760. So I don't know what's going to happen in the next coming days. Are we going to retest and bounce back? In other words, we came down to 2850. We rallied up to what this week?
50%.
Yes, but I'm not looking at it at 50%. It exceeded it slightly, and I can justify it.
Okay.
3136, right?
Yeah.
So look at the estimates for 2020. S&P earnings estimate 158.41. Multiply this by 1978, and you get, guess what? 3133. We got as high as 3136 in reaction to the Fed rate cut. We came up and retested it on Wednesday, and what happened since then? So they're selling into this resistance level right here.
Yeah.
Now, take what is valuation for me? Valuation is, how is the S&P trading relative to its fair value? I can draw a chart of the relative premium. In other words, is it overvalued or undervalued relative to the fair value? That's my last chart. Look here, what happens. Here's my valuation chart. The closing price of the S&P relative to fair value, is it trading at a premium or not? Look what happens. Every time it gets inside the mid-20s zone, we correct every single time. That's the model here. Something comes out of nowhere and triggers a correction. Now, December 2018, we were undervalued by 8 to 9%, which triggered this V-shaped recovery. Double top, January, February, double top in valuation. And as of yesterday, we're still trading relative to fair value at a 10% premium. That's why I don't think it's over yet, because they're still thinking that this coronavirus is a transient event. It's going to take, cause
Couple of months.
You know.
What are you really thinking here, Peter, away from the charts? I know you think about things like this.
Yeah, so I watched a video of a scientist that, she's from the UK. I think she's either Irish or Scottish, I'm not sure. But they had an interview with her. She flew in from California to have the interview in the UK. Guess what? They designed a vaccine in 3 hours, okay? That's how it took to design the vaccine. But then you get into animal trials, human trials, and then you need to produce millions of vaccines. Okay, what do you think that's going to take? So
a couple years, year and a half.
So let's say it gets contained. It gets contained, but there's no vaccine for it. So what is the consumer going to think? Well, you know what? I better save money, because if this thing causes me to be laid off, or a guy who has high hopes for a job or a new job say, you know what, I might not get it now. I'm gonna hold back on buying this new smartphone or buying this or that, and I'm just gonna be a little careful. And that's why I think.
How about going out for dinner?
Or even that, anything.
Yeah, everything.
And so far, the economy has been so strong, none of that has happened yet. But that's why I want to watch the numbers next month, the jobs numbers next month and in May, and we'll see what the true story is.
You know what, Peter? This was the best post-mortem on the top. And then what did doctors call it? And a prognosis of this patient going forward that I've seen in a real long time, man. Thank you so much for putting all this time and energy into edifying our community. We're all grateful.
Much appreciated. I always love coming here, and thank you again, and I hope to see you again, of course.
Yeah, so your family stay safe, please, Peter, and you know what? I'll talk to you a little bit later in the day, and we'll set something up for May and see how things are playing out.
Great.
That way we don't lose touch. And I said this on Twitter, I'll say it now, that you could be in my trading bunker anytime.
Much
Okay.
appreciated. I'll be
Well,
honored, and thank you all for attending this session.
yeah.
Thank you, Dale.
Good hunting, Peter.
Thank
Thank
you,
you so
sir.
much.
Have a great weekend.
All right, so that's it for us, Face. Hope everyone has a good weekend. Remember, most of all, especially in times when we're facing crisis, you never know if you have faith until you need it. So don't just count your pips, count your blessings. And actually, my S&P counter trend 3 drive is working. So I won't count that. I'll count my blessings. That means working with Steve and Stell and Blake and Grega and Joe and Andre and of course, you know who the one of the best female traders in the country is. She's in our chat room, not in the country, in the universe, Amanda. So have a great weekend, everyone. We'll see you on Monday. Adios.